Good afternoon, everyone. We're very excited to have you here. We're going to just give a minute. I see the tick up of registrants coming up, so just want to give everybody a minute to settle, and then we'll start. So give you 1 minute, and then we'll be back to start this panel. We're very excited for our speakers. So well, talk to you in about, oh, the minute's passed. Look, it's even great. Okay, well, I want to thank all of you for joining us today for this important discussion. As you probably know, Locus is celebrating 20 years of investing and unlocking community-focused capital. And today is an event and part of a series of in-persons and virtual meetings that we're having to lift up, to really showcase some of our high-impact partners, projects, and programs. I'd also like to really thank Nixon Peabody for sponsoring this session. But as I said, we are celebrating 20 years and we want to do a retrospective video about what we have been doing since we started 20 years ago. So we're going to play you a video and then kick off the rest of the presentation.
Back when we started Virginia Community Capital, I was governor, and I'd never heard at that point of CDFIs. But Mike Schul, my Secretary of Commerce, came with this idea, and because a lot of South Side and Southwest Virginia were really getting hurt, and they needed a different form of financing that was more about opportunity-based, that was more willing to kind of go the extra mile for some projects that might not pencil out. And it was remarkable. We got $15 million that started Virginia Community Capital. That's obviously morphed into Locus. That $15 million has grown to $600 million and billions of dollars of total investment projects. So I can't think of a single project that I'm more proud of that came out of my governorship than the creation of Virginia Community Capital and of then its transformation to Locus. And I know you're going to have other folks who are part of that growth, and it's really been a team effort all the way along. And I think the best is yet to come. As long as there's CDFIs out there, and particularly Locus, I'm going to be your champion, and whatever I can do to help, count me in.
One of the strengths of Locus has been our adaptability and flexibility to move from, I love this, $15 million of capital to now having $600 million of assets under management in under 20 years. Pretty good story. For Locus, it's about innovating around that and saying, yes, we know our principles. We're very financially strong. We're very analytical. Can we take more risk? Can we push that envelope a little bit more? And sitting there and going, because we've done it so well in one section, can we use that same learning somewhere else?
Well, I think the secret has been that once we established a track record and we had credibility, we have led. And I don't mean by the board, I mean the whole organization, that essentially we've done things that other people were not doing, and we have offered to help other people do things that aren't being done.
We have regulators, and you certainly want to protect the resources you have, but at the same time, it's a very innovative culture, very innovative organization.
What matters is, are we going about our business and helping people and helping communities?
Creating value and opportunity is more about someone's self-worth and how do we really influence the community to make sure it's long-lasting change. When you work with a lot of communities and diverse economic viewpoints, creating sustainability means someone's got hope. They can go from rental to owning their own home, creating generational wealth, and then you see the effect. And it really does help all the economy. When you do something day in and day out well for 20 years, you then kind of forget that what makes you special is that thing that you do well for 20 years. And so part of what I hope to bring with my leadership is to figure out how to grow that to make sure that it becomes a national name. Then bring other partners. And the way you bring other partners is by giving them other solution sets so that you're not competing, but really enhancing the industry as a whole. And to me, that's what makes us unique, is that we're okay and humble enough to say we are not the only solution in the market. It's not growth for growth's sake. It's growth for us to be able to sit there and say, not only did we help 100 people here in Virginia, but we helped 1,000 people nationally because we were able to help a CDFI network that was able to help their 100 people.
having warm, safe, healthy places to live, having access to health care, having jobs so that you can provide for your family, all those are the backbone of vibrant communities, and that's what we're all about.
To me, that is what high impact is about going in and not impacting just the unit or the developer, but really the lives of the people that we're trying to change. Let us put your money to work in the causes and communities you care about with trusted hands and people who can actually speak the speak, walk the walk, and take the action needed to make sure that you have everlasting impact in your funds.
So thank you again for joining us. As you can see, we're very proud of our 20 years. Again, my name is Pravina Raghavan. I'm the president and CEO. And in that video, you saw some of the work that we've done over the past 2 decades. But Locus has been financing solar energy products for over a decade. And in that time, we are proud that our lending has supported over more than 90 solar projects totaling $100 million. And through those projects, we've been able to finance 356 megawatts of solar generation capacity. And if you don't know what that is, that's enough clean electricity to power roughly 65,000 homes annually. In addition to our lending, we've also deployed nearly $4 million in guarantees towards our solar energy projects through our Community Investment Guarantee Pool, the National Multi-Investor Program, and part of our Credit Enhancement Fund Management practice. Across our lending and credit enhancement funds, our solar work spans geographies nationwide and intersects with key community development sectors. You can learn more about our work in our recently released impact report, and you'll find a link to that in our chat to make it easy for you. But as many of you are aware, this is a challenging time that we're all facing in this field. Capital constraints caused by the elimination of the Greenhouse Gas Reduction Fund have frozen pipelines and created obstacles for solar developers everywhere. That doesn't just mean less solar panels going out, but actually means more Americans are struggling with energy affordability crisis that's not letting up anytime soon. So you may be wondering, how do we thaw those frozen pipelines? How do we unlock the critical capital needed to keep projects moving forward, especially in the face of expiring tax credits? And who needs to be at the table? These are some of the questions that we want to explore today with both our moderator and panelists. We're proud of our impact, but none of this is possible without the collaboration of our partners in the solar finance space. Developers, foundations, economic developers, other CDFIs have all been part of this exciting journey. You'll hear from our friend Nicole Steele of Amalgamated Bank about how solar energy is the fastest, most cost-efficient way to address insufficient grid capacity. Afterwards, Nicole will be moderating a panel, and you will hear from one of our partner developers, Jared Lang, whose determination and innovation is pushing high-impact projects forward. He'll be joined by Bill Greenleaf, who leads Locus's solar finance program, and Jim Baek, who is part of our credit enhancement fund management team. They'll be discussing the impact of the current federal policies, environment, and priorities on solar, why some solar projects have stalled and died while many continue moving forward, how national solar developers and partners are adapting, how CDFIs are stepping up to meet the challenges through partnership with philanthropy and other green lenders. Now, it is my pleasure to introduce Nicole Steele, who will provide a snapshot of the current solar finance landscape. Nicole is currently the director of the climate policy at Amalgamated Bank, where she focuses on advancing clean energy, resilience, and efficiency through policy innovation, catalytical capital, and market development. She works closely with financial institutions, public agencies, philanthropies, mission-driven investors to help navigate the evolving energy finance landscape and scale investment in community benefit projects. Prior to joining Amalgamated Bank, Nicole held leadership roles at the U.S. Department of Energy and the Environmental Protection Agency, where she helped design major federal initiatives, including the $7 billion Solar for All program. At DOE, she led efforts to reduce soft costs and expand solar deployment, including launching initiatives such as the Community Power Accelerator and the Clean Energy Connector. Her current work focuses on how catalytical capital, public-private finance partnerships, and new deployment infrastructure can help sustain and scale energy investment during a period of major market and policy transitions. Thank you very much, Nicole, and I'm going to turn it over to you and the panelists for a great discussion.
Well, thanks so much, Pravina. Really appreciate that introduction. I almost feel like I don't need to say much more, but just dive into the panel discussion. But like Pravina said, I'm I'm really excited to actually be here today and be part of this conversation because we're at this sort of pivotal moment in time around clean energy, the clean energy transition, and just the deployment of solar. And so, like Pravina said, I'm the director of climate policy at Amalgamated Bank. And actually, that's a very different role from what I had initially intended to participate in when I joined the bank. Sort of stepping back a couple years, I joined the bank 2 years ago, right after we had announced the winners of the Greenhouse Gas Reduction Fund recipients, all three programs, including Solar for All. And I saw this moment in time where I had been working in the solar industry for 2 decades, really in the space of providing low-income homeowners access to the benefits of clean energy through philanthropy, through government subsidy programs. And I wanted to participate in this moment where we were transitioning the market. And so the Greenhouse Gas Reduction Fund was meant to seed market transformation, open up new markets. And instead, my role has shifted to focus on policy and catalytic capital. And the thing is that I think both of those things can still support that market transformation. What really matters is who comes to the table. And I think CDFIs and other intermediaries can play a huge role in this market transformation if done correctly. And so I like to say I play a banker on TV. I'm actually not on the treasury side, I'm not on the lending side, but have been in the financing space for a long time now. When I was the executive director of Grid Alternatives, I had to, Grid Alternatives Mid-Atlantic, I should say, based in DC, where we deployed solar in DC, Virginia, Maryland, and Delaware. We had to work with all different types of investors and funders, including the government, including philanthropy, to really deploy. And we also worked closely with affordable housing providers, and utilize their capital to deploy solar as well. And at that time, we had not taken on debt. And so we did not know how to navigate that sort of part of the ecosystem, partially because solar was in a different era. In that time, it was still a relatively new technology. It was still bespoke types of lending products and contracts. We were having to negotiate everything sort of as a one-off. The workforce wasn't there, the policy wasn't there. And so, when I joined the federal government, I helped design a bunch of programs that was like, if I was still running Grid today, what types of financial programs would be helpful to sort of, deploy more and faster. And so, that's when I got involved with the Community Power Accelerator, and that's where Locus, really came onto my radar in the work that you were doing around de-risking additional private sector capital and coming to the table because solar was still risky. And there is still risk involved in solar deployment, which is why catalytic capital and philanthropy is still necessary and still required, particularly when looking at projects that are community benefiting, where the off-takers are small businesses or potentially middle and lower income households. And so the work that I have been doing over the past year plus has been really sort of educating intermediaries and potential investors in the roles that this flexible catalytic capital can play in deploying faster. I think we all know that we're in an energy affordability crisis. And so, while we are transitioning away from tax credits and subsidies that were created under the Inflation Reduction Act and before, we are still able to sort of build durable systems. And we build those durable systems by building partnerships with CDFIs and other intermediaries, by driving capital to those intermediaries, whether it be philanthropic capital or government capital or like flexible investment capital. It's important that we are sort of playing a role in driving more capital to those intermediaries. But the other thing that I would add is it's also important that we are enabling lending products too that are more accessible and more affordable. Because, I mean, obviously, we're in an energy affordability crisis in that I was at an event a couple weeks ago, and every elected leader, speaking on stage was talking about energy affordability. And at no time in my career has energy been sort of at the top of a priority of an elected official. And so we recognize that there is a real opportunity for solar, even with the elimination of these subsidies. And so we all know that solar is the quickest and the cheapest form of energy generation. And if you pair that with storage, it helps facilitate an even stronger grid. And so, there is an opportunity for the solar industry and for lenders to really sort of lean in and ensure that everyone still has access to this type of energy and can really truly see the benefits. So I'm actually going to stop there because I want to make sure that we have enough time for our panel conversation. But I think the thing that I just want to encourage is that the private sector market can't finance every single solar project out there today, because there are still a lot of barriers associated with solar deployment, whether that be a new market, an off-taker that may be considered a little bit riskier, or a smaller project that is just not aggregated with a larger portfolio. And so there still really is a role for not only intermediaries to identify these projects and work with communities to help navigate the financing system, but also, de-risk additional private sector capital so that we can deploy more and faster. And so this is really a moment for collaboration and market building. So with that, I'm going to actually have each panelist introduce themselves. So let's start with Bill, and then Jim, and then Jared, and then we will dive into questions.
Thank you, Nicole. Thanks for the introduction, the opening remarks. Name is Bill Greenleaf. Been with Locus for 11 years. I'm Executive Director of Impact Lending. I joined Locus with a LIHTC multifamily affordable housing lending background, and I started our clean energy lending program 10 years ago. And I'll pass to Jim.
Thanks, Bill. Thanks, Nicole. Jim Baek. I'm a senior vice president here at Locus. I've been here almost 5 years now, and I'm part of the Impact Investment Services team, which is the part of Locus that designs and manages credit enhancement programs. So I would say the lending is probably what most folks know Locus for, the CDFI bank and loan fund. We also design and manage credit enhancement programs. These are backed by typically philanthropic investors, but also other impact investors. And we make them available to CDFIs and other users, other deployers of capital. We currently manage about 100 million of credit enhancement programs, funds, including our first fund, which is called the Community Investment Guarantee Pool. That fund had a focus in climate, among other areas. From a standpoint of being a CDFI and making credit enhancement available to others, we think that's really important because, one, we have firsthand knowledge about the challenges that mission lenders face in serving undercapitalized communities, making the deals that are kind of on the borderline, what Nicole was talking about, go. The second thing is that we're able to leverage our network of peer CDFIs to shape and deliver credit enhancement offerings that are needed by the sector. So I'm looking forward to talking more about credit enhancement and solar. I'll hand it over to Jared.
Sure, yeah. So I'm Jared Lang, with senior advisor with Community Sustainability Partners. We're a nonprofit set up to do a couple things. One of them is to provide technical assistance to state and local agencies that are trying to inject energy dollars into uh, community development projects. Um, Another thing that we do is we actually advise a lot of CDFIs on how to set up energy investment programs, how to underwrite and raise capital for those programs. But I'm here mostly today as in our role as a developer of solar on top of affordable housing and a frankly a user of Locus. Lending products and guarantees. So excited to be here and talk a little bit about where we're going in the energy transition.
Well, fantastic. I mean, I think if anybody has been in this space for a bit of time, they know that these three individuals are superheroes in the financing of solar, particularly with those with community benefits. So I actually want to start with Bill. So Bill, what are you seeing in your solar pipeline in this more challenging capital environment? And really, what is moving forward and what has stalled? And if you could talk a little bit more about sort of the why.
Sure. So the headline story for 2026 would be we've had a surge in solar lending requests compared to 2025. For just an example, the past 2 weeks, we had 7 new solar loan requests come in. But when you go beyond the headline, it's a mix of community solar projects, feed-in tariff projects, and PPA projects with mostly smaller solar developers, some first-time developers, some experienced developers. And so I just want to talk about some of the things we're seeing in the market and the challenges that have resulted from the freezing of the GGRF money. So, like I said earlier, we mainly serve smaller solar developers, and what we've seen is this might be their first or second project they're coming to us with, but the development team has a lot of experience that they gained from somewhere else. So, and a lot of the energy revenue contracts are very bankable. But one of the challenges we're seeing is because it's a new solar developer, they don't have a lot of liquidity on their balance sheet. They don't have a lot of any reoccurring income, and they come looking for $5-10 million solar loan. It's very difficult for any lender to get comfortable making a larger loan to a smaller organization. So that's a challenge. So an example is, last year, Locus was approached by an emerging solar developer in the Midwest that had 3 $9 million solar projects. They were shovel ready, they had everything in place, but they had they'd never financed before. It's their first time. And so we weren't comfortable even making a loan on one of the 3. We brought in some other CDFIs, and they all concluded the same message to the solar developers, we're not gonna be able to help you here, but your best approach is to sell the projects, which is what they decided to do. On the other hand, we've had plenty of solar developers come to us where the projects are smaller, maybe 1 to 5 million, where we have been able to be helpful. But an impact of the freezing of the GGRF money and the sunsetting of tax rates early is they come to us, do their first project, and normally we don't want to do the second loan until the first loan has been, the construction is complete and is converted to a permanent loan. This is usually 9 to 12 months down the road after we close the construction loan, but they need the second loan 3 to 4 months down the road while their first project is still under construction. So we have we've been accommodating, and we've like I'm thinking of one customer example. We did the first loan, we did the second loan, we did the third loan, all within 6 months of each other. These are all solar construction to perm loans. When they came with the fourth loan, we said we need to pause on the fourth loan. We just can't. And so we referred them to another CDFI, right? So we're being asked generally to work with a lot of smaller startup solar developers, have very impactful projects. But they all want to do all these loans all at one time, and so we're having to be very cautious and find ways to mitigate risk, and such as partnering with another CDFI to share the risk. So it's put a stress on the system. I think any solar developer any solar lender I've spoken to this year has all had a surge in solar loan requests, and so we're all trying to figure out how to get through it and try to meet this kind of moment in time.
Well, I think that's a good pivot to Jared as a solar developer. So Jared, can you talk about the challenges from the other side that you and other developers are facing in this environment? And then also, I really want to hear about the safe harbor loan you recently received from Locus.
Sure. Yeah. So I think, we do a lot of we work with a lot of housing developers that want to take advantage of their roof space to generate new income and support environmental sustainability. And what our biggest challenge is that we have to educate them about how solar works. Most of them are pretty familiar with like real estate, and we have to figure out how to kind of wrangle sites. And a lot of them they saw this long runway of the solar investment tax credit being extended out to 2032 with in the Inflation Reduction Act. And they were very excited about sort of like getting up the learning curve about how, how solar works and how they're going to safely and deal with the risks and integrate it into their properties. And when the, big beautiful bill passed, many of those developers that were starting on the learning curve said, "Oh, we don't think this is worth it." They just put a lot of the plans on the shelf, and they just are not willing to take the time to carve out to take the capacity, from other things and learn solar. At the same time, there were a lot of groups that we were working with that realized that the window is closing and that they just needed to jump right away. And so we've been busier than ever with a smaller handful of partners.
I mean, that's great that you are busy. And so I think that's a good spot for Jim. Would love to have you give us a bit more of an in-depth overview of the Community Investment Guarantee Pool that you oversee as the executive director. And then just talk a little bit about how those guarantee funds help unlock that sort of critical capital that Jared's looking for solar projects. And if you can give a couple more examples of the types of projects you've seen supported by these enhancements, I think that'd be a great addition to the conversation.
Yeah, happy to, Nicole. So, as I mentioned, CIGP, or Community Investment Guarantee Pool, was our first credit enhancement program that we launched. That was at the very end of 2019, so kind of right at the beginning of the pandemic. It was a national program, national effort. It was backed by 17 different guarantors, mostly foundations, philanthropy. And together, the investors committed about 66 million towards the fund, towards CIGP. The focus, as I mentioned earlier, included climate, but it also covered affordable housing and small business finance. And from the beginning, kind of the programmatic, the impact focus of CIGP was to support innovation and equity in those community development sectors. We recently finished our investment period, our origination period. We through CIGP we issued 27 guarantees totaling a little over 70 million to a bunch of different organizations, about 24 different organizations or users. About half of them were CDFIs, and the other half were other types of lenders and financial intermediaries that were mission focused. Just kind of to complete the description of CIGP, the main metric that we track here from an impact standpoint is how catalytic can it be in terms of unlocking or enabling other capital to flow in. So to date, our guarantees have unlocked about 180 million of other capital. When all is said and done, in about another 9 years, we think that'll be over 400 million of capital. So a great deal of leverage and efficiency in terms of that, 70 million of guarantee supporting that much of additional capital. The credit enhancements that were issued through CIGP could be done on a loan by loan basis, on a project by project basis, or on a portfolio of assets or loans, or actually on an issuer or a enterprise basis. I wanted to talk about Nicole, you asked if I could give a couple examples. I'll try to give a couple examples that mix that. I would say most of the guarantees that we ended up issuing were on a portfolio on a pooled basis. So one of the solar kind of use case guarantees was to a mission driven lender. It was not a CDFI. However, they had a great deal of track record around affordable housing, community facilities, not so much around the solar space. They were relatively new to solar lending. There was a developer that had been serving many of the communities that this lender worked in, primarily working with nonprofits and religious organizations to put very small solar projects on their campuses or on their buildings. These are projects that might be 50, 60 kilowatts, like under 300,000 in total development costs. And the lender was asked to provide total financing, sort of construction to perm. And as a relatively new lender to the space, they were looking to looking to the sponsor or the developer here for credit support. And as it happened, the developer, the sponsor in this case, was a relatively small organization. It was very focused on this sector. And while they've been in, as Bill said, operations for several years, their balance sheet just didn't enable them to be, in the eyes of the lender, a credible guarantor and supporter. And so the credit enhancement that we provided through CIGP provided a pool-based protection. So we provided a fairly small guarantee, 500,000, to support about 2.5 million of lending for this lender, and that was about 15 to 20 small projects that they were able to do in the Pacific Northwest primarily. Another guarantee that we issued was similar size projects, but I would say maybe slightly larger, a different kind of risk. This was not a risk for a lender. This was a developer that was focused on healthcare facilities serving low moderate income communities. So a lot of federally qualified health clinics and other health clinics and health I would say community-based clinics that were serving low-income communities, underinsured communities. And they were looking at solar projects on these facilities, as well as storage, as a way of providing more resilience during outages, during extreme climate events. They had an investor that was interested, an investor tax credit for these solar projects. The investor was looking for some additional credit protection. Again, the developer here, relatively young developer, did not have a large balance sheet. The investor did not feel like they were a credible provider of that recapture risk guarantee. And so CIGP, in partnership with another foundation, provided that recapture risk on that the ITC investment. So similar project, a slightly different part of the capital stack that the credit enhancement supported.
Yeah, that's super interesting. Really appreciate seeing it, support in a few different ways. So I actually want to pivot back to Jarrett quickly, realizing that you didn't actually touch base on your safe harbor loan. So I really do want to hear about that. And then once you talk a little bit about that, I want you to sort of pivot and talk about some of the other like biggest friction points that you are experiencing between capital providers today and developers. And I'd love to kind of hear your perspective on how we could potentially solve them.
Mm. Okay. So yeah, I guess in an effort to serve all of those housing owners and organizations that were eager to make sure they captured the solar credit, the solar tax credits before they went away, our organization pulled together a pipeline of $50 million in projects over the next 3 years. And then we went to Locus and took out a loan to secure about $2 million in solar panels. Um, and that loan was backed by a guarantee from Jim's side of the shop, and then the equipment itself. And we combine that with another about $1 million in solar panels that we have secured in a warehouse in central Pennsylvania, and we've been kind of like rolling through the pipeline as we build and providing the equipment to our installers all around the country into these projects. It was really, really helpful of Locus to support us to be able to meet the terms for safe harbor so that we can secure the tax credit. And now we have, for our pipeline, we have until 24 years. We did this at the end of 2025, and we have until December 31st, 2029, to finish all of the projects in our pipeline. And we are currently working right now with Locus actually on a construction loan or revolving construction loan product as a partnership with Locus and the reinvestment fund, um, where we can then use as a takeout for the equipment loan and then fund the construction for the pipeline. Bill, anything else to add in that?
No, I just feel like we're able to meet the moment. It is pushing our risk box a little bit than what we're normally comfortable with this, a larger loan, newer borrower, an accelerated timeline to get everything done. That's the stress on the CDFI system right now.
Yeah, we understand. And you know, we've been like at Community Sustainability Partners are a group of people that have been doing this for a long time. We've just been doing it from within inside other nonprofits and housing organizations. And so 3 years ago, we set up this new nonprofit to be able to focus exclusively, and specifically on energy investments. Um, and so we are working through some of the growing pains of being a smaller organization and having a smaller balance sheet. And we appreciate the CDFIs getting creative, like Locus and the reinvestment fund, getting creative and trying to figure out ways to underwrite our projects and put the proper, um, monitoring and controls in place to get themselves comfortable with the lending. And so we are on the precipice of closing this $20 million construction loan with you all. It should be, the next day or two that we have it done. And then will be into construction on our whole portfolio, our whole $50 million portfolio. So we're really excited about it. We're busy as all heck, just trying to get this done. And, Nicole, just you asked what are the constraints is like, um, we don't really have a plan for after this. Our hopes are that we're starting to identify some markets where we can buy solar cheaply enough and the power rates are high enough that it makes sense without the solar tax credit. Um, we actually applied for a Enterprise Community Partners Innovation Grant to sort of build out this approach of like where do we go after the tax credit. And we're hoping that there's some kind of like meeting place where so we can get solar equipment and a development project cheaply enough and power prices are high enough where there's kind of a crossover. But this is new. It's new territory.
Yeah, I think that's a really good point. I mean, as I said before, I think we're very much in this financial transition, sort of post-subsidy. And I had a frank conversation with some of our lenders and was like, so how do we fill the tax credit gap? And there was this sort of casual response of, well, they just need to bring more sponsor equity to the table. But not everybody has the ability to do that.
I mean,
Um,
sponsor equity has to be repaid. So
Absolutely.
that doesn't solve it.
Yeah. And so to your point of like, we're seeing energy rates increase. And so that's actually making solar financeable because of those rate increases. But that's not actually going to help folks that are looking for the benefits of clean energy in terms of like reducing their energy burdens. And so one of the things that I think is important piece of the puzzle is reducing soft costs. And those soft costs can include like the cost of financing. And so
Yep.
that's where a lot of catalytic capital can play a role in not only driving down rates, but also, either eliminating or covering fees that may be part of the capital stack. And so really trying to sharpen our pencils in terms of getting, these projects across the finish line and getting the capital stack down to a point where it's still affordable to, households and businesses that need to see their energy burdens go down.
Yeah, and I mean that's why we set up this revolver, this construction revolver, because we have to do some commoditization, right? Like
Right, right.
we're gonna have to somehow, all of this can't be so boutique. We're gonna have to come up with a 50 kilowatt or 100 kilowatt solar project for affordable housing that in a box,
Yeah,
like that we can kind of repeat. And then so what we're finding is like if we can get somewhere around like, solar pricing around like to the low $2 a watt, like 210, 220, and then we're in a market with power pricing that is like in the mid or the higher 20 cents a kilowatt hour, like 27 cents, 28 cents. So this is like, you know, Massachusetts kind of thing, some Rhode Island, Connecticut, some parts of New York. Um, we can make that pencil without a tax credit. But that
yeah.
doesn't fix the affordability issue.
No, not at all. So I think that's actually a really good pivot to my next question for Bill. And so I'd love, Bill, for you to talk about sort of some of the partnerships that you see coming together between CDFIs like Locus and developers. Um, as this like GGRF capital, as these tax credits are disappearing, and as we're having to sort of think about the capital stack in a different way while driving down deployment costs so that we can also be focused on affordability as well.
Sure, thank you. So it's been about partnerships for us. So we're working on our second lending partnership with our reinvestment fund to support a a nonprofit solar developer. The first being Capital Good Fund, the second being Church organization, Community Sustainability Partners. We've also partnered a few times with Montgomery County Green Bank to share the risk. They have lower cost capital. I would say in the past 12 months, I've seen a kind of an enhanced spirit of cooperation and collaboration amongst the CDFIs in the climate lending space to find ways to work together to help these solar developers get their projects financed. So if I can't do a project for whatever reason, I'm calling up another CDFI to see if they have an interest in it. I've referred several loans to other CDFIs, and I've gotten several referrals for loans from CDFIs that didn't have the capacity at the time or the capital at the time to provide the loan capital. And in some cases, the past couple of weeks, I've had loan requests come in over $20 million. That's far exceeds our $15 million lending cap. So I've reached out to larger solar lenders like Amalgamated Bank to inquire about it. If they end up being the lead lender, they would sell us our participation in the loan. So it's all about partnerships and collaboration amongst the climate lenders in this space to try to find ways to help these projects get financed in this shortened timeline that we have now.
And so, Jim, do you want to add anything around the sort of role of the credit enhancements and, really with the perspective of, like why funders who care about this space should consider investing in credit enhancement funds right now, and what that actually looks like?
Yeah. So I think the first part of your question of what are the implications or the applicability of credit enhancement, I think, kind of what we've heard now is that when you remove something like the tax credits, which, could be like 40-50% of the capital stack, you've got kind of a problem, especially if the rest of the capital stack can't be just filled by, sponsor equity or something else like that. And in terms of just the sheer, like, can you get this across the finish line? I think there's probably greater attention around the underwriting on project cash flows and sort of an issue that you kind of identified earlier, which is just like the perceived credit worthiness of the off takers, and whether that's in community solar or another structure. When you're in undercapitalized communities, I think that just gets a harder scrutiny. The size of the projects, the kind of even the sponsors as kind of the providers of guarantees on the project itself, that the kind of the financial strength that's available for that can be less than what many lenders are looking for. And so I think all of those situations are situations where the market is not going to work for those projects. And I think, credit enhancement is very good at just that sort of but for. And so understanding what are the gaps, can that be crossed with a particular type of credit enhancement? And that's not always the case, that, that bridge may be too far, or the kind of the set of issues just may not be addressable that way. But I think there's a real opportunity with the right structure of credit enhancement to help more of these deals, these projects that could happen. In terms of the message to the funders, or the opportunity for the funders and investors that care about these projects and where these projects are occurring, the resilience within those communities, I think it's really, now is the time. We've got this pipeline that was developed for GGRF. There is a way forward with the safe harboring, with the lenders that are there that are willing to take on these smaller deals like CDFIs. And I think it's really kind of the opportunity is there to step in and help more of these deals work and kind of function. And I think, what they might look like, I think it depends on what the need is for a particular project. But I think, Jared talked about potentially kind of grouping and creating some standardization around smaller projects. I think that's a great opportunity for philanthropy to stand up and kind of, create a standardization. Some standardization is needed. I don't. It's not always a great solution for every case, but I think, that's an opportunity where providing that sort of extra layer of credit enhancement might be what lenders like Locus and other CDFIs need to sort of take on a portfolio of smaller projects.
Yeah, I mean, I think there's a lot of folks would agree with that statement around standardization and how imperative that is for maturity in the capital stacks and the capital markets. And there's some interesting efforts underway, particularly at the Milken Institute, in thinking through standardization. And I know that like the GGRF folks were really hoping to lean into the standardization space because of the types of markets that opens and really just drives down the cost of capital. Somebody asked me this question the other day, and I threw out this big idea of like we really just need like a Fannie Mae for clean energy deployment, and there needs to be sort of this like backing of that sort of standardized product and really de-risking and really, like Jim, to your point, like philanthropy could take the lead. And I think there's an opportunity for government to take the lead in a few years. So with that, I want to make sure that we have time for questions. And so Valerie's going to talk a little bit about the process for that. I noticed there was a couple that came in through the Q&A and came in through chat. So Valerie, if you want to jump in and just talk about how you want to manage questions, and we can go from there.
Yeah, happy to. Thanks, Nicole. I do have a few questions lined up here, and so I'll ask those now. If you have questions in the audience, please feel free to, you can throw them in the chat or use the Q&A function. I'll monitor both. So first question, this person just noted that, CDFIs aren't typically doing solar lending outside of developed markets. What are the challenges that are keeping CDFIs from going outside of those developed markets?
I'll take this one. So what we've discovered, so we can do solar loans across the country. Most are in the up from DC up to Massachusetts that we work on. But every state has a different regulatory environment and incentive program. So for instance, we're starting to get some loan requests in Rhode Island. So we have to figure out the Rhode Island framework, right? And we do projects in Massachusetts. It's a different regulatory framework and incentive structure. And so it takes more underwriting time to understand each market. And therefore there could be a little more risk because, you don't truly know everything until you've been in a market for a few years. Like it took us about 5 years of lending in DC to really understand the SREC market. Like all the stuff that people don't tell you about. They tell you all the good stuff about it, but there's some things that you don't learn until you're actually in that market for 5 years and you realize, oh.
You gotta kind of take the ride, Bill. Yeah. Yeah, I mean, from a developer perspective, like when we want to serve, organizations in new markets in Michigan, in North Carolina, in South Carolina. And what we were really excited about with kind of the bonus adders and the GGRF funds was that we were going to be able to go in and make some mistakes. Like there's more risk going into these markets. There's construction risk, there's just like regulatory risk, and there's a lot to learn, the steep learning curve. And what I see a lot of is being through, several real estate cycles and solar cycles, they call it the solar coaster, is that, people retreat back to things that they know in when times are uncertain. And so I have definitely seen some of a retreat And what we have been pushing is that, like, for philanthropy to help us try to do more in North Carolina, where the utility has a lot of different regulatory requirements, and Michigan, and try to figure out how to make deals work in places that are not as easy to work in as Maryland and New York and DC.
Thanks, Bill. Thanks, Jared. Another question that I see here in the chat. Could you use a guarantee, Jim, to increase project debt and thereby reducing equity required?
Uh, yes, I think you could. I mean, I think you see this sometimes in the, can't speak as much to the solar world, but the housing world. I mean, you're effectively talking about balancing sources and uses. So if you've got a project that costs X amount, you need X amount of sources, and whether it comes from equity or debt, uh, you know, from a project standpoint, it probably doesn't matter too much. But there's a reason why lenders are, have kind of limits around how much leverage or LTV they're willing to lend to. And theoretically, if there is, there's a stronger sort of repayment guarantee from a third party around repayment of that debt, potentially, I think you could see that. Whether that works in the solar context, I'm not sure, but I think it's theoretically yes, and we see it in the housing side.
Thank you. And then another one that I grabbed from the chat, can new markets tax credits be used for solar, assuming that the project isn't a qualifying market?
They have been in the past, yes.
I've seen this. I haven't done it. But yeah, I've seen people use new markets for solar. Maybe it's time to explore that a little further, especially since I think new markets were, even in the big beautiful bill, were extended for a long term.
Well, hard to believe we're already pretty much up on time. I'm sorry to those questions, the folks that asked questions that I didn't get to, but we'll be sending some follow-up information to everyone who attended, and that'll include contact information for the folks on this call. So invite you to please reach out with your questions, and we can answer those and help make connections where we can't answer them. So at this time, I'm just going to invite Pravina back on to wrap us up. Thank you to our panelists and Nicole, our moderator.
Yeah, Pravina, thanks for having us.
Thank you, guys. Again, a very special thank you to Nicole and Jared. Jim and Bill work for me, so they have no choice, but we really greatly appreciate you sharing your experiences and insights. And again, thank you to Nixon Peabody. And Jared is correct, New Market Tax Credit is now a permanent program, so it'll be interesting to see how that affects how we can do more deals in solar. But I want to thank everybody who joined us and for asking such great questions. As Valerie said, we got more than we could answer in this short time, but we will continue to work on that. For our existing partners, we look forward to continue working together. For those we have not met but really are interested, we encourage you to reach out to our team. We love the opportunity to get to know you and find where we are mission aligned to able to help. As everyone shared today, this is the time for community-driven partnerships across the solar sector. It's not easy, and it will take all of us to find energy affordability solutions that our communities need and deserve. And if you're interested about Locus, please stay informed about what we're doing. Be sure to sign up for our Locus newsletter or follow us on LinkedIn, and Valerie will drop those resources in the chat. And again, thank you so much for taking the time for joining us. And again, thank you to our panelists. We really appreciate you taking the time. Take care and have a wonderful, happy Monday.
Thank you. Take care.
Thank you.